You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball, my co-host John McEwen. In this week's episode, we'll be discussing Next, PZ Cussons, Boohoo, Kingfisher, Saga and McCormick. John, should we kick off with Next?
Yes, so Next, the FTSE 100 listed clothes retailer, had their first half-year results out this week, which were very impressive. And just for reference, all of these comparisons relate to the 2019 figures. So total group sales were up 7.6% to £2.2 billion compared with 2019. That was nearly entirely driven by the online sales. Pre-tax profits rose 5.9% to £346.7 million, and full price sales in the first 8 weeks of the second half were up 20% compared with 2019 and ahead of analyst expectations. In the online division, full price sales were up 55% to £1.4 billion, with strong growth from the Next brand and the third-party label business. A new warehouse is being built to increase the capacity, with phase 1 planned to be operational by October 2023. Next also enjoyed strong results from its Total platform, which is a tech solution that allows other retail brands to use the warehouse, logistics, and other infrastructure for their own online businesses. And they got Child's Play Clothing, Laura Ashley, Victoria's Secret, and Gap all signed up. In the retail division, sales were down 38% to £540.1 million with the COVID lockdowns. In the finance business, with store credit cards, interest income fell 11% to £119 million, with customers paying off their balances sooner. Net profits came in at £66 million. Cost inflation is around 2% and is expected to increase to around 2.5% next year. Next now expects full price sales to rise 10% for the full year, and pre-tax profit guidance has been increased to £800 million. And they also commented that they have not experienced difficulties in recruiting staff in the stores, but have warned that deliveries may take longer, especially as Christmas approaches. A spokesman for Next said, "The daunting fact is that little other than outstanding execution and constant innovation across the entire business will enable us to maximise the ever-changing opportunities and challenges of an increasingly online world. It's a tall order, but we are in the fortunate position of having that chance." And on these results, the shares responded positively and were up 2.5%. In terms of valuation, Next has a market capitalisation of £10.69 billion and trades at 15.6 times earnings, compared with a 10-year average of approximately 13.6. And the yield stands at 2.5%. So overall, Next is a company that I like. It's really grown on me, and it's a great example of what might be called hybrid retail. It has a very slick online presence with click and collect, storage at its retail units, which tend to be more focused on out-of-town retail units. And it sells quality but good value products with high customer retention, and it's delivering strong growth online while the competition, well, a lot of it's going out of business. So yeah, I don't think it's an unreasonable valuation either at 15 times earnings. What are your thoughts on it, Sam?
Yeah, similar. I'm very impressed with it. I think I appreciate that online sales are up 55%, whilst retail's down 38%, so it does skew it a bit. But 1.4 billion online sales compared to 540 million retail is fantastic. And as well, where it says half the store leases will expire or break in a little over 4 years, that's probably very good for them, because I'd imagine they'll have the owners by the balls when they renegotiate that.
Yeah, exactly. That's what I would have thought as well. So it's they are in a very strong position. Are there any things you don't like about the business?
Not really. I think 15 times earnings is pretty reasonable, really, for a business of that quality.
Yeah, I mean, I think I always used to fear it wouldn't be able to adapt, and that actually it would be sort of all the business would go to your ASOS and Boohoo's, but that clearly hasn't happened, and it has that very high customer retention rate.
Yeah, I mean, yeah, like you say, if it was going to happen, well, it's pretty obvious by now that that's not going to happen when almost 75% of the sales are online.
Yeah, and I suppose it has proved that it's a different company to those more traditional retailers that, as we've seen, have gone under.
Yeah. I really like it. I think it looks like a very well-run business. I think I was impressed with it last time. I'm impressed with it this time. I don't think the price is outrageous.
No. I wouldn't be averse to taking a position in Next at the current price, really. So is it one for your watch list then?
It is actually. It probably is. Yeah, I think it is one for the watch list. I don't know if it's better than anything I own at the minute, but I do like it.
Yeah. No, fair enough. Okay, PZ Cussons.
Yes, PZ Cussons. For anyone who's not familiar with PZ Cussons, you are probably familiar with their brands. Their brands include Carex, Natural Source, and Imperial Leather. And then they've got a few other ones as well, but those are probably the main brands. So they have come out with their full year results. Revenue from continuing operations was up 2.7% in reported currencies to 603.3 million and up 7.1% in constant currencies. Adjusted operating profit from continuing operations, and we are going with the adjusted figures because they've adjusted them down. But adjusted operating profit from continuing operations is up 7.7% to 71 million. Adjusted profit before tax from continuing operations is up 11% to 68.6 million. Adjusted basic earnings per share from continuing operations is up 7.8% to 13.12p. And net debt at the year end, excluding lease liabilities, is down from 49 million to 30.7 million. They've highlighted that must-win brands revenue grew 11%, with 7 of the 8 brands in growth. And on a 2-year cumulative basis, must-win brands revenue grew 21%. Carex revenue doubled, reflecting the increased size of the hand hygiene category in the UK and their continued market-leading position. Gross margin increased 60 basis points to 39.3%, supported by price mix improvements in each of the core categories. Adjusted operating margin increased 60 basis points to 11.8%. Like I say, they adjusted the results downwards. So those adjustments were mainly as a result of items relating primarily to the impact of disposals, head office and regional restructuring, and the simplification project in Nigeria. There were a few interesting points in the slides. So they've split the revenue by region. Europe and Americas total revenue of 217 million. That was up 4.8%. And the adjusted operating margin was down 210 basis points to 24%. Asia Pacific revenue was 187 million, and that was 1.7% growth. And the adjusted operating margin was up 110 basis points to 11.1%. And Africa revenue was 193 million, and that was up 16.2%. And adjusted operating margin was 5.6% versus a loss in the 2020 year. I thought it was interesting actually because that revenue mix, so 193 million from Africa, 187 from Asia Pacific, and 217 Europe and Americas. It's a pretty even split across the three actually.
Yeah.
Yeah, for the 2022 financial year, they said they're expecting a return to revenue growth from Q2, and they highlighted that volatility remains from COVID-19 and supply chain disruption. In terms of the valuation, the company's trading at a market cap of 962 million and a PE ratio of 17.19, with a dividend yield of 2.71%. My view is these are impressive results. I like the brands. I like how much exposure it gives you to Africa. I just think at a PE of 17, I'd rather have the Unilever. That's where I am with it.
And for reference, what's Unilever trading at the moment?
Unilever's at 18.65.
Yeah, I would tend to agree with you because I think I would agree. I like it for the same reasons that I like Unilever, but I think Unilever probably has some stronger brands. And for that reason, if everything else is equal, I'd probably go for Unilever. I was also going to just ask you what you thought of the increased cost that they were facing. And I think there was a figure for the Imperial Leather soap and the Carex hand gel. It was sort of between 9 and 10% in the cost of materials just to make those soaps, moisturizers, and the plastic packaging that goes with them.
I struggle to worry about cost increases because I don't see a scenario where you can't successfully pass it on to the consumer, because everyone's got cost increases and everyone's talking about inflation. So I just think it's going to get passed on. I struggle to see them be squeezed on it. What about you?
Yeah, I mean that's what, as someone who has a lot of consumer goods, that's what I like to think, that they will be able to be passed on. And I suppose whether it's brand versus non-brand, that people will opt for the brand and the power in that brand. So yeah, that is my view, and it hasn't stopped me. I haven't sold them, I've held them. I haven't actually been adding to them, but I've got Kraft Heinz, I've got Reckitt, got Unilever. So that it's a similar story with all of them, and it's not something that's troubling me too much.
Why wouldn't they pass it on? I don't really see, because I think Unilever will be passing it on. I think Reckitt will be passing it on. So
yeah, it wouldn't be PZ Cussons for you, but you don't dislike it as a company.
No, I think for an example, like say you're talking about Unilever at 18 and PZ Cussons at 13 or 14.
Yeah,
it's a very different conversation for me. Yeah. Whereas when you're talking about PZ Cussons at 17 versus Unilever at 18, I just think, well, why wouldn't you buy Unilever or Reckitt?
Yeah, fair enough.
But yeah, at a price, it would be quite interesting.
Yeah, okay, fine. On to our next company, which is another retailer. So following on from Next, we have Boohoo, which, for anyone who doesn't know, is predominantly in the UK, but it's growing in the US, and it's an online fashion retailer, exclusively online. It's listed on the alternative investment market. They had their first half results out this week, announcing that sales were up 20% to £975.9 million compared with the same period last year, with growth in the UK and the US. However, growth in the second quarter was tempered by return rates returning to normal in the UK and other physical stores or physical retailers being reopened. Sales in the UK, which currently account for 58% of group sales, were up 32% to £569.6 million. However, acquisitions made up 20% of the growth. Gross margins were down from 52.1% to 51.7% with the increasing returns. In the US, sales were up 23%, ignoring exchange rates, to £250.6 million. And when compared with pre-pandemic levels, sales have more than doubled. At the same time, discounting had been reduced, which led to gross margins increasing from 59.3% to 61.5%. In the rest of Europe and the rest of the world regions, sales were down 14% in both 104.7 million in Europe or rest of Europe and 51 million in the rest of the world. Distribution costs are up nearly 25%, with international shipping going up by £26 million. And this is not expected to go away anytime soon, along with the wage inflation. Underlying cash profits, EBITDA, came in at £85.1 million, a decrease of 5%, with a higher marketing spend, warehouse and shipping costs. There are an additional £20 million of costs not reflected in the EBITDA, including dual warehouse operating and admin costs, along with some redundancies. Full year underlying EBITDA is expected to be between 9 and 9.5%, which has been revised down from the previous guidance of 9.5 to 10%. Meanwhile, full year sales growth is expected to be in the region of 20 to 25%. And that's below the medium-term target for annual sales growth of 25% and underlying EBITDA margins of 10%. It's also worth mentioning that Boohoo do plan to open a new North American distribution centre, along with increased technology and infrastructure spend to take full year capital expenditure to £275 million. And to keep ESG investors happy, the group have explained that the agenda for change is ongoing and have said, we've completed 1,142 audits of overseas factories, in addition to ongoing audits of the Leicester manufacturers. We are working with other retailers, brands, local government organisations, enforcement bodies and NGOs within the apparel general, merchandisers, public-private protocol, AGM-PPP, to collaboratively transform the UK garment manufacturing industry. On the results, the market didn't respond well and shares were down 10% on the day. Valuation-wise, Boohoo has a market cap of 2.58 billion and trades at 21.4 times earnings, with an average price to earnings ratio of 40 since listing in 2014, and it doesn't pay a dividend. I think it's difficult with Boohoo at the moment because it does appear to have a more reasonable valuation, and margins are still very good despite them being downgraded. But I suppose what would worry you is whether things are going to get worse with increased costs, and if there were to be a continued sales slowdown. So I think on balance, it's probably worth a look, especially with the addition of some of those high street brands, the ones that had previously been bricks and mortar, and Boohoo's mopped them up. So Debenhams, Dorothy Perkins and Coast, which not the strongest brands, but without the bricks and retail dragging them down, I think Boohoo could probably do quite well with them. And they do have nearly £100 million of net cash on the balance sheet. Sam, what are your thoughts on Boohoo at this slightly less punchy valuation compared with what it had been trading with over the last few years?
I mean, we've covered it a couple of times on the show already, and both of us, I think it's fair to say we both preferred it to ASOS, but thought it was more expensive. And we weren't, we thought it was, quite pricey, really. And since then, it's been cut in half. It does look interesting, actually, now. I think a PE of 20. I mean, the market cap was 4 or 5 billion when we last looked at it. And I mean, how the shares did. Geez. So in a year, the shares are down 40%. They're down 38% in 6 months, 32% in 3 months, 22% in a month, and 20% in a week. Still 90% over 5 years, though. I mean, it's where it was. You're going back to like start of 2019. Yeah. And it's been growing at, I know the growth slowed a bit now, but it was growing at 50% a year. It's profitable. I just think even if the costs go up, because the revenue is still growing at a decent rate, I think it's still going to be able to maintain the current level of profit, even if margins are lower. And I think as well that obviously the USA sales are only 250 million compared to 560 million in the UK. They're actually growing a bit slower at 23%, but that's going to have a much higher ceiling. And it's got higher margins in the US compared to the UK. Yeah. I think it looks quite interesting.
Yeah, I would tend to agree with you. I'm actually becoming, now that the valuation has come down quite significantly, and I suppose it's a trend, in terms of the sales that we wouldn't want to see continue, but it is much more attractive, and I'd probably be adding it to my watch list.
I just think as well, obviously, there is still a lot that can go wrong from here, but a PE of 21, I think that there's a lot of potential upside.
Yeah, no, I would tend to agree with you there.
I wonder what ASOS is doing at the minute. Yeah, I mean, ASOS is, we've not looked at the ASOS results recently, but ASOS has had a similar pullback. Looks like ASOS is at a PE of 23. And just I mean, it's almost like the opposite of what we saw a year ago with the retailers.
Yeah.
Do you not think?
That's right. I suppose, and I mean, you could buy both.
Yeah,
quite legitimately. Yeah,
I think the fact that ASOS has done so poorly as well. I mean, like I say, we've not actually looked at the results, but I imagine it's experiencing similar issues, given that they're very similar businesses.
Yeah.
But if it's happening to ASOS as well, it's not like it's pure execution from management or anything. It's just, I think a good time to buy retail was probably a year ago, and this could be a good time to buy Boohoo and ASOS.
Yes,
They're both going on the watch list actually.
Yeah. No, I would. They're going on mine as well. Okay. So back from online retail to bricks and mortar, Kingfisher.
Yes, Kingfisher, a company we've discussed before, a company that we liked. They have come out with their half-year results. Sales were up 19.9% to 7.1 billion. Gross profit was up 23.4% to 2.697 billion. Gross margin was up 110 basis points to 38%. Operating profit was up 53.9% to 747 million. Earnings per share was up 74.8% to 26.4p a share. They highlighted that delivery against Powered by Kingfisher strategic priorities are ahead of schedule. They've highlighted that new longer-term industry trends are creating growth opportunities, which we'll talk about in a little bit when we get to the slides. They've highlighted that £300 million is to be returned to shareholders via a buyback programme, reflecting strong cash generation and confidence in their outlook. So sales were up 22.2% in constant currency, and they said that's driven by strong demand for home improvement across retail and trade channels. In terms of breakdown by country, they said that performance was strong in the UK and Ireland, France, Iberia and Romania. However, Poland was impacted by COVID-related temporary store closures in Q1 21-22. Transaction volume and average basket value are both up on a 1 and 2 year basis. Like-for-like sales are down 0.8% in Q2 21-22, and corresponding 2-year like-for-like sales are up 20%. E-commerce sales are up 21%, with 2-year growth of 216%, driven by continued strong demand. E-commerce sales make up 19% of group sales, and in the half 2 years ago, they only made up 7%, but they're basically flat from a year ago. Well, I guess if more of the stores are opening, that's actually quite a good performance to manage to hold that. Retail profit was up 45.1% in constant currency, driven by strong UK and Ireland profit growth, and France profit growth was over 100%. Free cash flow was 723 million, and that was down 30.6%, largely reflecting a reversal of working capital inflow in the prior year related to inventory. Net debt to the last 12 months EBITDA was 0.5x, and that's down from 0.9x at 31 January 2021. They said they're making good progress with the core strategic priorities, including e-commerce with accelerating focus on last mile delivery, store hub model implemented in Castamora, France and Poland, with further investments in B&Q's hubs. They've also made progress with their own exclusive brands, including the successful rollout of a new kitchen range in France, Poland and Romania. They've had several mobile-led and service innovations, including installation services at B&Q, new mobile app for Screwfix, self-checkout terminals, a new 3D kitchen and bathroom design tool, accelerating rollout of Need Help Services Marketplace in the UK and Poland. And they've highlighted multiple cost reduction programs in motion, including improved inventory health and availability. Where they talked about the long-term industry trends creating growth opportunities, they split that into four different areas. So they've said more working from home. 50% of all people surveyed work from home for the first time, with more working from home likely to continue. And 50% of those who've worked from home say they will do more DIY in the future. Second area is a new generation of younger DIYers, with home improvement and DIY activity among the younger age group up significantly versus 2019. Among the 18 to 34-year-olds, 64% improved their DIY skills, and 71% feel more confident to take on DIY, and 75% enjoyed it. 18 to 34-year-olds scored the highest versus other age groups. The third area is the active housing market in the UK and France. House moves tend to generate significant incremental demand for the following 12 to 18 months. The moving pipeline looks robust for now, fueled by the pandemic and low interest rates. More money is spent on kitchens, bathrooms, electricals, and general DIY following house moves. And the final one is a focus on energy efficient homes. In the UK and France, approximately 75% of the building stock is deemed energy inefficient. Both countries have net zero commitments, giving considerable potential for green renovations. And Kingfisher currently derives about 9% of its group sales from energy and water saving products. And in terms of the geographic summary, so total revenue 7.1 billion, 3.57 billion is UK and Ireland, 2.4 billion is France, 0.74 million is Poland, 0.196 billion is Iberia, and 0.152 is Romania. The average profit margin is 10.8%. For the UK and Ireland, it's 16.2%. France, it's 5.3%. Poland, 8%. Iberia, 5.5%. And Romania, it's negative 3.7%. In terms of the valuation, well, when you factor in these half-year results, they're trading at a PE ratio of about 9 and a market cap of 6.98 billion. And the dividend yield is about 2.5%. John, thoughts on Kingfisher and these results?
Well, I think the results are really pretty good. I guess it's not trading as high as you might expect it to be, but do you think that's a fear of these sales not being, or these results not being continued, really? It's sort of, if you were to play devil's advocate with it, that it's sort of a flash in the pan with COVID, it'll return to, well, not impressive sales growth. And where does the future growth come from?
Yeah, I see that. But I think if you look at how they've executed so far, that hasn't happened. I mean, the fact that the online sales have maintained the same proportion, I think is quite impressive. Yeah. There's obviously, like they've highlighted, there's a lot of tailwinds that you expect a business like B&Q to benefit from.
Yeah.
If you go back and you look at the last 5 years' revenue numbers, the growth isn't outstanding. So yeah, I think you are right. I think there's an element, even if the sales aren't going to decline, they're probably not going to grow a huge amount after this year based on the historic track record. But a PE of 9, I'd say, does it need to?
Yeah. So I suppose if you make those assumptions and that it is trading at a price to earnings of 9, well, I guess it could be. It does offer a somewhat a value proposition to you.
Yeah, and if it does, if management do continue to execute, if all of these things they're trying, if they work, if they have more growth in, for example, France, I mean, that margin in France is low. If they can bring that up, that would significantly help the earnings. There's a lot. Yeah. I mean, it's probably low for a reason. I mean, I think they might be number 2 in France, and that could be part of the reason. Whereas in the UK, they are number 1. But there are levers they can pull. I don't know. They're probably not going to absolutely smash the market, but I think you've got a lot of downside protection, and you've got a very good business there.
Is it one that you would be buying shares in?
Probably not, but it's definitely good enough for the watch list. I do like it.
Okay.
What about you?
Probably not, but I can understand the reasoning behind it.
Should we move on to one that's also probably not going on your watch list?
Well, yeah, I won't spoil it, but Saga. So it's a company that's traditionally known for its cruises for OAPs, but it does also offer general insurance, personal finance products, along with a monthly subscription magazine product aimed at the over 50s. And they had their half-year results out this week with underlying pre-tax loss of £2.8 million compared with a £15.9 million profit last year. This was in line with what the market had been expecting, given the pandemic and suspension of the travel business. If we go through the sectors, it had the retail broking business, which saw profits fall 9.8% to £37.9 million, with boarded gross written premiums falling 15.5% to £175.8 million. The insurance underwriting division had underlying net premiums fall 9.1% to £84.1 million, with a 7.8% fall in the number of policies underwritten and a small decrease in the pricing. However, the underlying combined operating ratio, which represents the percentage of premiums paid in and claims out, and costs, was improved from 101.6% to 88.4% as a result of fewer motoring claims with lockdown. In the travel division, which is Saga's best known for, revenue was down from £49.3 million to £10 million. Cruise ships began to sail at the end of June, but the ships initially could only be half full due to social distancing. Encouragingly, 74% of cruise advanced receipts have been transferred to a future booking. Marketing costs were up nearly 27% in the division with the restarting of the cruising. There's an underlying pre-tax loss of £51.2 million compared with a £34.2 million loss last year. Overall, Saga generated £26.1 million of free cash flow compared with an outflow of £92.2 million last year. And Saga issued £250 million 5-year bond in July, with the proceeds being used to repay existing debt facilities. Net debt came in at £740.3 million, approximately £20 million less than at the start of the financial year, but still pretty huge. In terms of valuation, Saga has a market cap of £485 million and trades at 8.3 times earnings, compared with an average price to earnings of 10.4 since listing in 2014. I suppose you'd summarize it by saying it's been an incredibly difficult year for Saga, and I suppose you do feel sorry for them, really. They've got so many headwinds and a mountain of debt. I guess with things relaxing a little bit, people having both vaccines, you could see some upside, but I mean, it's a business that's in real distress, and it certainly wouldn't be one that I'd be looking at investing now or probably anytime soon. Sam, can you see anything positive for the business?
It probably won't be as bad next year, I guess.
Do you think it's fair at the current price, or do you think it's not far off what Kingfisher's valuation?
No, yeah, I suppose you'd argue that it is on depressed earnings, but yeah, I think it's expensive. I think that much, because it's in a lot of industries. I mean, the insurance is fine actually, but the travel side and the cruises, they're just not industries you want to be in. So to be in them with that much debt, I mean, the debt was 740 million. The market cap's only 485 million.
Yeah,
and it's at a PE of, what is it, about 20. It's just the debt compared to the earnings is absolutely insane. It's, as a shareholder, you don't own that business. The debt holders own it. It's I'd short it before I bought it. I'll tell you that.
Okay.
Well, not that I'd short anything, but that's the sort of business that I'd look at shorting.
Yeah.
It's just it doesn't look good.
Yeah,
I do feel sorry for them, like you say, but don't make investment decisions on who I feel sorry for there.
No, it's not a charity case.
No.
But yeah, and I wonder as well. I mean, yes, it's on depressed earnings, but whether the group that it targets, especially in the travel business, are your OAPs, how likely are they going to be going back to cruising, even with the vaccinations?
That's the problem. If you send a cruise ship out 75% full, you still got the same costs.
Yeah, quite. And also, it's even if it is 100% full, do you think that the older people who are more at risk of COVID are going to want to go into that sort of environment? I can't see it happening. Struggle. Yeah, I think we could both agree the least favorite company of the week.
Yeah. It's probably one of the worst businesses we've looked at, actually. It's not really their fault. Well, I guess the debt's probably their fault. I'd imagine for the debt to get, I've not looked in detail, but for the debt to get that high, they must have had a significant amount pre-COVID.
Yeah. And then post-COVID, with all the disruption, I don't think it warrants any further discussion.
No.
Should we move on to our US company of the week, McCormick?
Yes, McCormick. So, for anyone who doesn't know, which in Europe probably won't, so they do like herbs and spices and anything you can think of where it adds flavor to food. So their brands are actually in over 160 countries, but I've gone down the list and I don't really recognize any of them. So I think it is more US, but it looks like they do have some strong brands. So
You don't have any Swartz,
I've never heard of it.
pepper, herbs? No.
No. Maybe my palate's just not as sophisticated as yours. Do you recognise some of their brands though?
I do. That's the one that I've come across.
I think Frank's Red Hot Sauce. I know that one.
Okay, yeah.
I just felt like with this company, from what I gathered, it's kind of how I feel looking down that list of brands is possibly how maybe someone in, like, I don't know, the US would feel looking down Unilever's brands, where they're quality.
I don't know about that. What about Ben and Jerry's?
Yeah, that's true. I'm trying to think, maybe Reckitt's then. Whereas, they're obviously quality brands, but they're just not quite as popular.
Yeah. Okay.
It's not a reflection of the brands.
Right.
It's just that they're bigger in the US, I think.
Yeah. Okay.
So they have come out with their Q3 results. They've announced that third quarter net sales grew 8%. Adjusted operating income was comparable to the previous year, and adjusted earnings per share grew 5%. And if you compare those figures to 2019, net sales were up 19%, adjusted operating income was up 17%, and adjusted earnings per share was up 18%. They highlighted that they've had 6 consecutive quarters of double-digit consumption growth versus 2 years ago, and that's in the Americas. In EMEA, which so it's Europe, Middle East, and Africa. So Europe, Middle East, and Africa, double-digit growth of branded herbs, spices, and seasonings consumption growth versus Q3 2019. And in Asia Pacific, they highlighted strong consumption growth in Australia versus Q3 2019. And they've said that McCormick is now the #1 global hot sauce manufacturer, with Cholula now #2 US hot sauce, joining Frank's, which is in the #1 spot. So for the operating income, there was a 3% constant currency adjusted operating decline for the total company. And they said that was due to the consumer segment decline of 12%, driven by cost pressures, including inflation and logistics challenges. Brand marketing increased 2% versus Q3 2020 and 11% on a year-to-date basis. The adjusted gross margin declined 260 basis points, which was driven by cost pressures, a lag in pricing, and a shift of sales between segments. Selling, general, and administrative expenses as a percentage of net sales declined 110 basis points, driven by leverage from sales growth. Adjusted operating margin declined 150 basis points. And for the 2021 outlook growth rates, they're expecting sales growth of 12 to 13% in reported currency and 9 to 10% in constant currency. And the contribution from the Cholula and Fona acquisitions will be 4% of that. They're expecting adjusted operating income increases of 6 to 8% in reported currency and 4 to 6% in constant currency. And in terms of the valuation, the business is trading at a market cap of 21.493 billion, and that puts it at a PE ratio of 28.51. My view is, I thought it was interesting to look, just because there's obviously some quality brands here. Really, you'd expect it to be sort of in line with, well, your Unilevers and your Reckitt's. I think a PE of 28.51, that's definitely an American premium in action there, because for those numbers, I mean, you'd be lucky if you get high single-digit sales growth in the medium term, I think, out of that business. So I don't know how it justifies a PE of 28. So I think that's quite an interesting comparison. That's all. I definitely wouldn't be interested in it, despite the quality of the business at that PE. It'd have to drop probably by about a third before it looks interesting compared to its comparatives. Do you think, John?
I would tend to agree with you on that. I mean, I have a few consumer goods companies already, and at that valuation, I wouldn't really look again at it. But it's not that I dislike it at all. I just think it's very expensive for what it is, and you can probably get better ones like Unilever, as we mentioned earlier, for cheaper. Yeah,
I just think a PE of 28, a lot of returns have been pulled forward there. Because if it's growing at 7 or 8% a year, for it to just come down to 20, it's got to grow at 7 to 8% for a number of years. And It almost reminds me of, in the 90s when Coke was selling a PE of like 44. And
I didn't actually know it was that expensive.
It might have even got close to 50 at one point. It's in one of the Berkshire meetings. Bill Ackman asked a question actually to Warren saying, "Don't you think it's quite high?" And Warren basically says, "Well, it's a good business. We're going to hold it." And actually, it would have been quite a good time to sell it. But yeah, it's in the 90s. Coke ran up into the 40s, and obviously Coke was never going to grow enough to justify that. So it just had like a 15-year period where it was just flat. Whereas now it's only about 30 PE. But I'd
probably look at Kraft Heinz before I looked at McCormick. Actually,
I would. Do you know what Kraft Heinz's PE is?
21.
21. Yeah, I mean that's more in line with like Unilever, isn't it? It's got in America, so you're going to pay a bit more.
It's got stronger brands as well, I would say, Kraft Heinz.
Yeah. So, of the 6 companies we've discussed this week, then next, PZ Cussons, Boohoo, Kingfisher, Saga, and McCormick. If you had to buy one, which one would it be?
Oh, it's actually quite difficult. I mean, I know which one I wouldn't want, but it's between Next and Boohoo. Actually, I'll probably be safe and say Next.
I'd go with Boohoo, and what I would say is if you asked me which one I expected to pick before we did this, I would have said Kingfisher.
Yeah.
But yeah, I didn't expect Boohoo to be that cheap.
No. Very good. Well, I think on that note, we'll finish. Thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.